So we're looking at Serenity Gym and Health Centre. This is a service from question from the 2014 higher level paper. And we're just looking at the adjustments for the fixed assets. So calculating the cost for the balance sheet, the accumulated depreciation for the balance sheet, profit loss and disposal, and revaluation reserve. The first one we're going to look at is buildings and buildings depreciation. The start of the year on buildings we had 620,000. We haven't sold any buildings, there's nothing here, and there's nothing at the bottom of the question about selling any buildings or disposing of any buildings or land or anything like that. But on the payment side, we can see that there's a new extension, and a new extension means that we've purchased additional buildings. So what I've done here is we've our buildings the first 620,000, which you see at the top of the question. I've added on the new extension because that means we have more buildings now. So our buildings is up to 850,000. That 850,000 then will be multiplied by the depreciation amount, which you see at the bottom of the question at 2%, and that's giving us our depreciation for the year. That's an expense. It's depreciation for the year, so it goes into our profit and loss. The next thing we're going to look at is revaluation reserve. So we see here, if we look at the question, it gives us information on the 31st of the 12th, which is the end of the year. Serenity Gym and Health Centre Limited decided to revalue their buildings to 900,000. So when we do our balance sheet straight away, that 900,000 is going to go in as a cost figure. We're not going to worry about that for now. What a revaluation reserve adjustment is for is to find out how much the value increased at to get to 900,000. And the amount that it increased by is going to go into our balance sheet in the finance by section. So we're going to look at what we've done already. We had our 620,000, we've done it up here anyway, and we added on the new extension. This is the same thing here. That means that our cost of buildings at the end of the year was 850,000. Now that's the cost. We've had depreciation, accumulated depreciation for 3 years, which we dealt at the start of the question up here. So that's 3 years accumulated depreciation. Obviously that's going to bring down the value of the buildings from 850,000 down to something else. And we've also had depreciation for the year. So not only have we had 3 years accumulated depreciation before 2013, we also have depreciation for 2013. And we've already calculated that as well to be 17,000. If this is our cost at the end of the year, this is 3 years accumulated depreciation before 2013. This is the depreciation for 2013. This is our 4 years accumulated depreciation in total. That's going to be taken away. That is our net book value of buildings. On the very last day of the year, that was how much our buildings were worth. Now on that day, we decided to revalue them to a new figure, 900,000. So if the value was 795,800 and it jumped up to 900,000, it means that it jumped up by 104,200, and that's our increase in value. That goes straight into our revaluation reserve in our finance by section. We've completely dealt with buildings now. When the next fixed asset we're going to look at is equipment. So our equipment at the start of the year, you see it in the question, is 70,000 at the start of the year. There is no indication that we sold any equipment at all. We didn't dispose of any equipment, but we have purchased new equipment. We see that here, 15,000 on the payment side. So we had 70,000 euro worth of equipment at the first of the first. We bought another 15,000. So now our cost, our balance sheet for equipment at the end of the year is going to be 85,000. If the cost at the end of the year is 85,000, it means that we need to get depreciation on that 85,000. The depreciation is at 10%. So we're just multiplying that by our cost and it gives us 8,500. That's our depreciation for the year, and that goes into our profit and loss as an expense. Now, there is no revaluation, there's no disposal, there's nothing else. When we go to the balance sheet, 85,000 is going to be our cost, and we're going to need to put in a depreciation figure on that balance sheet as well. That depreciation figure has to include these 3 years that we dealt with at the start. The 3 years accumulated depreciation before 2013, because that's depreciation that basically that was a reduction in value for the equipment for having it for the previous 3 years. It has to be included. We've also done depreciation for this year, 8,500. So when I'm doing my accumulated depreciation in my balance sheet, I have the 21,000 which would have dealt at note 1. That's 3 years accumulated depreciation. And I have this year's accumulated depreciation of 8,500. So on my balance sheet I have €29,500 as my accumulated depreciation in my balance sheet at the end of the question. So that's going to be my cost in the balance sheet, and that's going to be my depreciation in the balance sheet, and obviously then I'll just calculate my net book value. Well, this is our last adjustment. This is our vehicles. We see here on vehicles there's a good bit of information. We had vehicles in the first of the first for 90,000. They're the vehicles we had at the start of the year. In terms of trying to calculate the cost of the vehicles, during the year it doesn't give us any information on our receipts about selling a vehicle, but it does give us information about purchasing a vehicle here. We're going to look at that later. We're not going to put in the €50,000 now. At the bottom of the question it gives us information about selling a vehicle which had cost 40,000 on the 1st of the 1st 2010, so 3 years ago. That vehicle was traded in, and it's telling us about a new vehicle there. So it's telling us that we had a vehicle and it cost 40,000. Whenever we are trying to dispose of a vehicle and take it out of our accounts, we have to take it out of cost. We don't look at the depreciation, we don't look at the net book value. The original cost at the start of the year was 90,000, and I have a vehicle which had cost 40,000. So I have to take that 40 away from that 90. 90,000 at the start of the year, disposed of cost, figure 40,000. That always has to go to cost, it'll never go to anything else. After that, we see that we've purchased the vehicle, so we can't close off our vehicles account because we've purchased the vehicle. It says that we've paid 50,000, but we're not going to put that figure in. The reason we're not going to put that in is because it says here the new vehicle cost 59,000. When you're dealing with balance sheet figures here or anything like that, you can see it's always cost. These are the figures that are cost, these are the figures going to the balance sheet as cost in the balance sheet. So we've 90,000 at the start of the year. We disposed of a vehicle and we purchased the vehicle. The cost of the vehicle we disposed was 40,000, and the cost of the vehicle that we bought was 59,000. So we're going to take away the 40,000, we're going to add in the 59,000 for the purchase. That gives us 109,000 for cost for our balance sheet. That's the figure that we're going to use to calculate our depreciation. Now, we didn't buy that vehicle on the 1st of the 1st and sell the vehicle on the 1st of the 1st. We did that on the 1st of the 7th. So for the first 6 months of the year, this adjustment here didn't happen. For the first 6 months, all we had in vehicles was this, 90,000. So for the first 6 months, from the 1st of the 1st to the 1st of July, I have 90,000 multiplied by my depreciation amount, 20%. And that's obviously 6 months here, so that's my 6 months. That's giving me €9,000 depreciation. That was the first 6 months. And I know it's the first 6 months because the adjustment here says on the 1st to the 7th. So that 9,000 basically is one portion of the depreciation for this year. Now, the separate 6 months here, from the 1st to the 7th, we sold the vehicle, and on the same day we purchased the vehicle. That means for the last 6 months, the cost of our vehicles is 109,000 because we had our 90, we sold the 40, and we bought the 59. So 109,000 is going to be the cost from the 1st to the 7th to the end of the year. So the same thing again, 20% depreciation, 6 months, that's giving me 10,900. So my depreciation at the start of the year was 9,000. My depreciation at the end of the year was 10,900. That's my depreciation for the last 6 months of the year. So my depreciation for the entirety of the year is 19,900. I don't take away anything else. I don't have to look at anything else. I just have to look at what was my cost for the first 6 months and what was the cost for the last 6 months, because you multiply cost by depreciation amount by total months to get your full depreciation. So that's all I'm looking at. 90,000 cost start of the year, 109,000 cost from July onwards. 19,900, that goes in as depreciation for the year in my profit and loss account. Now the next note we're going to look at, because we had a disposal in our vehicles, we have to find out whether we made a profit or loss on that disposal. The first thing you always start with is the cost, and as I pointed to the last time, we had 40,000. That was the cost of the vehicle that we disposed of. That's the cost there. That wasn't the net book value, because obviously that vehicle would have had depreciation. We know we've had it from the 1st of the 1st 2010, which is 3 years before these accounts started. And we also have it for the first 6 months of this year. So you have it for a total of 3 years and 6 months depreciation. Now you can do that separately. You can find your depreciation for the 3 years, multiply 40,000 by 20% by 3 years, it'll get you 24,000. And then you could do the 6 months, same again, 40,000 multiplied by 20% by 6 divided by 12, giving you 4,000. That'll give you 28,000 total depreciation. Or you could do it this way. You could have your cost, 40,000, depreciation amount, 20%, and 42 divided by 12 months is basically, you're looking at 3 years and 6 months. So 1 year is 12 months, 2 years is 24, 3 years is 36. So 36 months is 3 years, another 6 months because we had it from the 1st of the 1st to the 1st of the 7th, which is 6 full months. So 36 and 6 is 42. So 40,000 cost multiplied by 20% depreciation figure multiplied by 42 divided by 12 months gives me 28,000. That means that my net book value for my vehicles, my cost minus total depreciation for the 3 years and 6 months gives me €12,000 net book value. That's how much it was worth. Now, we didn't receive all of that. If we received less, it means we made a loss. There was an allowance of €9,000 given on the old vehicle. They basically valued it at 9,000 and we valued it at 12. So we've made a loss. We have our proceeds there. That was the allowance of 9,000. That was our value. It means that we received €3,000 less. So that's a loss and it goes into the profit and loss as an expense. The last thing I'm going to look at for my vehicles is going to be this figure here. What this is going to achieve is this is going to find us our balance sheet depreciation. Basically, we have our cost figure for our vehicles, which we've done up here. That's going to go into our balance sheet under cost. And we don't know the accumulated depreciation figure that's going to go in. The reason we don't know it is because we have had a disposal. So we've vehicles that we've sold and there was depreciation in that, and that's got to go. We know that we did 3 years accumulated depreciation already. The start of this question, the 3 years multiplied by 20% by the original cost, and that was 54,000. Now from that, some of it would have been from the vehicles that we disposed of. We also have to add in our depreciation for the year, which was 19,900. Now, just to simplify it and to put three figures together, I'm just going to add the depreciation for the year, and I'm going to add the previous depreciation for the 3 years. Included in those two figures are going to be parts of the disposed vehicle. I know my disposed vehicle had a total of 28,000 depreciation. So if I just add my depreciation from the start of the year, the 3 years depreciation, and I add my depreciation for the year, all I need to do then is just take away the depreciation from the vehicle that I just disposed of. So 54,000 depreciation, total depreciation that we looked at the start of the year for 3 years. We've had 28,000. We know that that was sold. We know that 3 years belongs to obviously 3 years depreciation was on it previously, and we know that we had 6 months this year, which is actually 4,000. We're just going to take out the whole figure as it is, and then you just add in your depreciation for the year. Those three figures, that gives us 45,900, and that's my balance sheet depreciation figure.